This is the Skin in the Game VC podcast, hosted by Tom Wallace, entrepreneur turned venture capitalist and the managing partner at Florida Funders, along with Saxon Baum, general partner and head of investor relations at Florida Funders. You'll learn from the best about investing in early stage tech companies, so you too can gain the confidence and find the tools that help you succeed as an angel investor. Are you ready to get some skin in the game?
Hello, everyone, and welcome to another edition of the Florida Funders Skin in the Game podcast. We're really excited that you could join us today. We have a very exciting guest who we're going to introduce here in a second. For those of you who are new to the pod, we're always having success. Our goal is to have successful entrepreneurs, founders on, as well as successful investors, and it's all about learning from each other. So that's what we're always doing, and what excites us so much is about being in early stage technology investing. It's always so dynamic, and it's always changing, and there's always something new to learn and somebody new to learn from. So with that, Sax, how's it going?
All good, Tom. As we were saying earlier, it's 90 degrees in Florida, so we are hitting summer here, but it's all good. We've been really good at Florida Funders. Everything good around the table, so no complaints here.
Yeah, so it's getting hot. Just things are heating up here, just as things are heating up with all the tariffs that are hitting us.
Yeah, that is true. Real and fake tariffs, I will say.
So, we had a board meeting with one of our portfolio companies that, long story, they import stuff from China. So they're looking at 145% tariff and trying to figure that whole situation out. But
called a pass through, right? Pass that right through.
Yeah. In theory, but go ahead.
All right. Yeah, we're so excited to have our guest here. A great friend of mine, Roger Ehrenberg. Roger and I have known each other for 5 or so years. We're both on the board of Better, Joey Levy's company in the sports betting space, Joey Levy and Jake Paul, that we've talked about on the pod before. Also, Roger is a co-investor with us in Gemini Sports, where he has a board seat as well. Roger Ehrenberg, welcome to the pod.
Thanks so much, guys. It is awesome to be here. And I'm glad you're not cooking too much down there in South Florida. But, we're kind of cooling it at 75 and sunny in NYC.
That's what it's all about. I was there last week. As I told you, it was absolutely gorgeous. Roger, you have an amazing story. You've been so successful in your career. Why don't you get the audience up to speed, how you got to where you are today? We're going to dive into some pretty heavy topics. But how did you get to where you are today? Tell us your story.
I sometimes ask myself that question. There's definitely a sense of it being somewhat surreal. I started out on Wall Street. Was there for 17 years at Citi and Deutsche and derivatives and quant trading. If you had said to me, when I was in high school, you're going to be a really senior guy on Wall Street and in trading, I would have been like, get out of here. Like, no shot. So there was definitely this sense of unreality about going out of the trading floor every day and being like, wow, this is my thing. But then after 17 years, I was running this multi-billion-dollar trading business at Deutsche. I really just got tired of the politics and just all the stuff associated with being at a giant company. And I quit and had started doing some technology angel investing just as a side project. And when I had more time and space to actually pursue it, I spent the next almost 5 years off my own balance sheet, seeding 40 companies, leading 6 rounds, sat on 6 boards, and discovered that I really loved working with builders in the technology space, loved being around the hoop, pre-product market fit, and started to refine my craft and develop a thesis around kind of the next wave of technology evolution. And that was around big data in 2008, 2009, and decided to raise a fund called IA Ventures in that era, coming out of the global financial crisis. And I will tell you that starting out was a struggle because it was the combination of some ex-Wall Street guy in New York City starting a tech VC. What?
In 2008, 2009.
Yeah, right. Exactly.
Yeah.
It was like,
I can imagine that was difficult, Roger.
It's like the notion of like emerging managers didn't exist yet. And especially in New York, there was basically, there was Union Square Ventures that, Fred Wilson and Brad Burnham started in 2004. You had the RRE guys and you had like Josh Koppelman in first round, kind of had a New York presence, but it was so early. And I just kind of put my flag in the ground. I had built a brand. I started blogging. I had a really popular blog called Information Arbitrage that kind of helped communicate what I was doing and how I was doing it. I brute forced a first close of 17 million at the very beginning of 2010.
There you go.
But through this group of mentors in the venture space that I had cultivated and who were just great friends and supports to me, like Fred Wilson, Brad Feld of Foundry, Josh Koppelman of First Round, uh, Peter Bloom of General Atlantic,
Those are some
Matt,
pretty good mentors.
Matt Harris of Bain, who was at Village Ventures at the time, just great people, great humans, and great investors. So I had actually planted some LP seeds, right, who I knew weren't going to give me money right up front, but were going to follow me. But fast forward, middle of 2010, this little crappy firm in New York had led multiple rounds in West Coast technology companies like the Trade Desk. We had done Datadog in New York. We had done this company called MetaMarkets that ultimately was bought by Snap. We incubated a company that's now Vectra Networks. So at that point, we had kind of proven the thesis that, okay, we can actually do this. And in the first couple of quarters of 2010, it was originally a $25 million fund on its cover. We ended up having 85 million of demand. We ended
Wow.
up closing on 50. And
It's
that's
always
how
good to be oversubscribed.
that phase
Nice problem to have, right?
got
How
started.
how
No,
are
I
you
mean,
getting access to these deals, Roger? These great West Coast deals. I mean, was it through this LP network that you built?
no, it was through the brand that I had built at early IA, but like all of the angel work I had done, all of the networking, all of the co-investing I had done with other VCs. And because I was investing so early, like when we backed Jeff Green in Trade Desk, he didn't have his co-founder yet. It was a PowerPoint that obviously is not
Pre-revenue.
that pre line of code. But it was it was an industry that I understood extremely well, having seeded Invite Media in the RTB, in the DSP, in the kind of programmatic advertising on the demand side.
Yeah.
That's where I'd focus. That's very much like a Wall Street trading business. And my thesis was ultimately that all media was going to be traded like you trade equities on an
Mhm.
exchange, real time, rapid fire, like high frequency trading, which is exactly what's happened. But when I first co-invested with Josh Koppelman first round, backed these two 19-year-old kids out of Penn to do Invite Media, which ultimately was bought by Google for $85 million and is now a tens of billions of dollar company inside of Google and powers a lot of their real-time bidding. I learned a ton. Then I seeded a company called TubeMogul with my friend Howard Linson, who runs Social Leverage. And TubeMogul ultimately, they were a video DSP. They ultimately went public and were bought by Adobe for $400 million. So I had this deeply held thesis. And then so I understood both the incumbents and understood the challenger brands like the Media Mass, the Turns, the Data Zoos, people like that. And then met Jeff Green. And he had co-founded an early company in the space called AdECN, bought by Microsoft, but he felt like they had not nearly achieved their potential and had clarity of vision as to what the future would look like. He could not raise a dime because people thought, there's all these heavily capitalized VC-backed next generation real-time bidding platforms, and then you've got the Googles and the Facebooks. It's like the game is over. And Jeff's like, the game hasn't even started. And I believed him at the time. My colleagues at IA believed him. And we ended up co-leading their seed round with Founder Collective. And then we bridged them 3 times. Then they had a small Series A. We invested in that too. And then they went from $8 million of primary capital raised. That's all they needed to build a $50 billion company.
Wow.
But
Unbelievable.
Yeah. Did you see so much of what you're saying parallels Florida Funders? We started as angel investors, then raised our first fund, which was 18 million. So it kind of cut our teeth on the whole angel investing side as well. going to Jeff, did you see with Jeff Green, hey, this is the guy? Or was it you believed that it was the right space at the right time? Or was it a combination of both?
No question, it was both. I had a deeply held thesis on the market, but if we hadn't met a guy like Jeff or Jeff, then we wouldn't have done anything because ultimately it comes down to execution. Ideas are
Totally.
great. It's all about execution.
Oh,
And we
absolutely.
had,
And by the way, we love guys like Jeff that have had a successful exit prior. Maybe it wasn't huge because they're still hungry and scrappy and they want to go again. That's our favorite kind of founder to invest in.
the chip on the shoulder, yeah, because like AdECN was bought by Microsoft for 60 million bucks. It was really in many ways, a failure to the founders. Microsoft wanted, Jeff, the team was based in Ventura, Southern California, wanted Jeff and the team to move to Redmond. He's like, no shot. And he was just mad. He was just irritated.
It sounds like Aaron Roost, one of our founders.
Yeah, Aaron Chernin, this founder of Roost.
Aaron Chernin at Roost. I'm sorry.
Yeah,
similar situation. He sold his first company for $80 million to a larger company and felt like, he left a lot on the table and we backed it. He's done really well. It's one of our really successful companies.
Roger, one thing I want to double click on here is this pre-seed investing. A lot of investors these days that we hear are scared of pre-seed. We typically, if we're investing pre-seed, it's got to be an experienced founder. There has to be a differentiator. How do you feel about pre-seed then compared to now? Do you still have that thesis where you guys like to go extremely early?
Yes.
Yeah.
To me, I love investing in pre-product market fit founders. I love being part of the process of helping them develop the experiments to test whether or not it's worth continuing on and building a big company. So kind of metering in dollars, giving them enough to run these early experiments, and then helping them get to the point where they could raise a true seed round from people like you, and to then also write another check into it. So to me, again, it comes down to I have some theses about spaces, but then I will collide with amazing people who open my eyes to, wow, there's a really interesting opportunity over here. And if
Mhm.
I think they're great, and if I can see how, if these experiments prove out, this could actually be a venture scale company, then I'll write a check. And part of the reason, guys, why I'm now doing what I'm doing in my post IA life in sports media entertainment is because there's literally nobody like me doing it, going this early in this space. Everyone is downstream of me. And like to me, that's the opportunity because even though it's not obvious to some that sports media entertainment creator economy is going to yield venture scale companies, I know it will. Like I am deeply convinced it will, and that it's early in the same way that big data was early in 2008, 2009, and it was non-obvious. This feels pretty similar. Like I talk to LPs because I may well raise a fund. And so I've been kind of road testing my theses. And for some, it's like, yeah, this is different, man. This is really cool. And some, and these are people that know me a long time and I've made a lot of money. So there's a general bias towards wanting to be supportive. They're like super cynical about the ability to build venture scale companies in this space. And I'm just like, we've seen this before.
Yeah.
You just don't have the imagination.
Yeah. I think we're with you on that. Being that you invest so early, Roger, are you looking for, if you invest in 10 companies, as you said, pre-product market fit that early, how many of those do you expect to be successful? How many don't work out? What are the numbers? How do you look at that?
Well, there's how do I look at it going in, and then over long periods of time, what have I observed? Because those are different things.
Yeah,
If
give
I
us
invest
both.
in 10, if I invest in 10 companies, I expect 10 to be successful. Otherwise, I wouldn't have written the check in the first place.
But they're not going to be.
I don't go in with that mindset. How do I know if
I
I
like
will
it.
be or not? I'm
Yeah.
just saying,
Yeah.
if I'm like, I've done the work, this is a great person, this is somebody I want to work with, and B, I believe this space has the opportunity to be disrupted or substantially augmented by this company existing in the world, I expect it to be successful. The reality is, because I'm investing so early and because that thesis, those experiments could break down in a dozen places between here and there, oftentimes they do. And so let's say that 30% just right don't get anywhere. Let's
Zeros.
say
Yes.
zeros. Let's say another third or so partial return to return of capital ish. And then another third are more than return of capital with, call it 10 to 15% generating venture scale returns. And then, like, if you look at a typical IA Ventures fund, which honestly looks very similar to what I've done, like IA one, 50 million, looks very similar to what I've done off my own balance sheet in terms of portfolio construction and capital deployment. So at IA one, we ended up having, call it 28 to 30, for ease of, let's just say 30 portfolio constituents. And let's say three of them, four of them are going to be like significant venture
Big
scale
hits.
returns, big
Yeah.
hits,
Yeah.
little over 10%. Um, and then a third crap, and then pretty much those numbers I think are actually pretty representative
It's the
of
same
my
exact
portfolio.
numbers that we've seen and we go into our funds with.
Yeah.
Yeah.
We do the same thing. Third.
With
Third going to zero. Third we'll get our money back and we'll make all our money on the other third.
with a few, handful being big hits.
Yeah.
Yeah, I mean it's nuts. So if you look at IA Fund One has so far, because there are still a couple of $1 billion plus companies in the
So that was a
portfolio.
2009 fund.
2010, call it January 1st,
2010 fund. Okay.
2010. So we're 15 years in. There's still two um, not yet exited, but massive, 9-figure ARR companies in the portfolio. But that fund has so far returned net of fees 9.5x.
Wow.
That's a hell of a
Congratulations.
fund.
Yeah. Wow.
So what do you do with those two
Fund
companies
two,
that are
fund
still
two
out
is
there?
better. We let them grow.
And your LPs, since they've already gone back almost 10 times, they're fine with that.
Correct.
Yeah. And then how big was two? How's two doing?
So two was 105, and that
Okay.
was 2012. And that is 14.5x net DPI,
Jeez.
21 TVPI.
Very impressive, Roger.
Mm.
Very impressive.
So did you, was
That
there,
puts you in the top like 1%.
for sure, 0.01%.
Yeah.
Yeah, that's awesome. Was there another IA fund or was it just those two?
No, there's IA3, which is 160,
Okay.
and an IA4. So IA3, I was around for the entire deployment cycle, and that's honestly, it's still early. We've got several 9-figure ARR companies in that portfolio, and then 4 is very new.
But you're not still at IA, correct?
No, I
What's that
left
story?
about, so built this firm, brought in a couple of amazing people. My partners, Brad and Jesse. Well, I brought in Brad at the very, very beginning, and then Jesse came 18 months later, and the two of them now run the firm. Great humans, brilliant people, way smarter than me. And we did this thing together. In 2021, a couple things happened. So we were kind of early in starting to invest out of Fund 4. It was COVID. I actually lost both my parents in a fairly short span of time. And I really just lost the passion. And I'm the kind of person, I am a 150% always on person. And if I'm not that, then I'm not me. And when I set up IA at the very, very beginning, I made a promise to myself and ultimately a commitment to my partners that if I wasn't going to be all in, I was going to be out. Because I had observed kind of the venerable Silicon Valley firms that were on Fund 14, where the original GPs were still sitting there collecting $10 million plus of management fees, not doing the work, not letting the younger generation get ownership. And I just absolutely hated that. I thought that is not the culture. That is not the vibe I want. And that when I was ready to go, I would literally hand the keys, give up all claim to the management company to my partners, to those who were continuing to work and manage the book. So that's what I did. I decided to give the firm to Brad and Jesse, which they are now running very, very well. And that I then started my next adventure. And I had started investing in sports while I was still at IA. I made the investment in the Miami Marlins, and then I had started to make a couple of angel investments. Does this sound familiar? This is like when I left Wall Street, and then I decided it's literally the exact same process, just 15 years later with a lot more money and an established brand as a successful venture capitalist. So I had way more organic deal flow. I had doors that I could open because, and this is what got in ultimately to my strategy of how I'm doing what I'm doing, which is kind of the franchise investments really were an unlock in many ways to both understanding the gaps and opportunities within professional sports technology stacks and infrastructure, but also network. Because let's face it, between kind of the family offices that control sports teams, league officials, and sports private equity firms, you have a lot of connectivity. And so that was super helpful for me spending that first year post IA really networking and meeting people, and then doing a bunch of investing, meeting a ton of founders, building relationships with people like you guys and other folks in the ecosystem. And so over the last coming on 4 years now, I've deployed uh, and committed, tens of millions of dollars to the sports franchise side, right? I've got, the Marlins, Alpine Formula One Racing, Real Salt Lake and the Utah Royals, a very famous European football club that I can't publicly name. I can tell you offline. And then I'm part of the group that's bringing a WNBA team to Detroit. So that's
There you
kind of
go.
the franchise activity. And then on the venture side, seeded 29 companies, 14 concentrated investments, and deployed between 40 and 50 million off my own balance sheet. And I'm now exploring, whether or not I actually want to build a business around my sports media and entertainment practice.
Wow,
So
very
let's
impressive.
talk a little bit about Eberg Capital, because that's really where a lot of this fits in, correct?
Correct.
So your two sons, who I know very well, they're very involved in the business. How's it been working with your kids on this one?
It's really been awesome because it really happened organically. We never had a family business. When my wife and I got married, we had zero, literally zero at age 27. Everything we've built together. So it's all new. This business, Eberg, is less than 4 years old. So there was never a plan. It just so happened that at the time I decided to do this professionally, not just as a hobby. Each boy was at an inflection point. In the case of Andrew, he graduated from Michigan, informatics and entrepreneurship, worked as a product manager in a machine learning company for 3 years, did Web3 and crypto VC for a year, and then was figuring out his next thing. And then Ethan was at University of Michigan Ross School of Business, where he was kind of informally advising me while he was in school on some of the sports investments and gaming investments that I was evaluating. And then when I decided to make Eberg my next act, they approached my wife Karen and me and said, "We really want to work in the business." And we spent a bunch of time kind of processing that and decided that, if we could keep the very close personal parental relationship, friend relationship separate from the boss relationship, that we'd give it a try. And knock on wood, it's been working and working really well.
It's awesome.
Well, it's a great story. I don't know if you know this. Saxon's my nephew. So,
oh no, I'm sorry.
Yeah. So, I like to say how blessed I am to get to go to work every day with my nephew,
Awesome.
and it's
so
just
cool.
been great. There's nothing like it, and I'm sure you feel the same way about your boys.
I do, and honestly, it's like I learn so much from them every day because they really are.
Well, no, that's not the case here. He's grasshopper. He's grasshopper. He's learning from me.
I knew that was coming after the really nice line. I knew that was coming.
Yeah, come on, Sax.
I'm
you
kidding.
could have seen that from a mile away. Yeah.
Yeah, right.
No, it's awesome. I mean, Saxon knows Andrew and Ethan really well. It's just they are the customer. Like, they are the canonical fan in today's generation. They're jockey boys, smart, social media savvy, great friend groups, highly social, tapped into the cultural zeitgeist, gaming, music, cool art, just everything. So their taste in their network has been really informative as we've looked at stuff, especially stuff that has that kind of consumer face to it, where you're, really talking about, again, to me, it's been interesting as I've thought about potentially raising money. It's forced me to be more crisp about what's in here and being able to talk about it. And I think ultimately it really comes down to the fan. Everything reduces to the fan experience. What are all those things that you can deliver to a fan? What's the content? Where are you consuming the content? How are you consuming the content? With whom are you consuming the content? What can you do while you're consuming the content? Live, synchronous, async, mobile, you name it. That's what it all comes down to.
Yep.
And so
And
if
that's who's
you're
paying too.
all of it, 100%. Or if they're not directly paying, then you're able to monetize their eyeballs indirectly.
Yep.
So
to me, it's all great businesses that I've ever been involved with were very customer focused. And, the founder typically had a passion for staying very close to the customer, making sure the customer experience was fantastic. And here you're saying the same thing about the fans, and they are the customer, right?
100%. But it's interesting what you say about founders. There's definitely, and it doesn't matter how technical the founders are, great founders have an aesthetic. They understand where their product stops and where the customer starts. And whether you're doing something that's like API based to be consumed by an engineer, a developer, or it's something that is absolutely customer facing, like an app on a phone, right? Both require an aesthetic and an empathy for who's going to be consuming that thing.
Yep.
So I think that's really critical input to, is somebody a great founder or not? Do they have that aesthetic?
I want to make sure we cover two things. And Tom, why don't you cover NIL and then I'll cover Detroit City.
Yeah, I'm just with your background and being so active in the sports space, I'm a big college fan. Florida Funders has made an investment in an NIL startup. We did that years ago. Company's doing fairly well. But I'm just kind of curious. And you're in Michigan, so with Larry Ellison paying $10 million for this high school kid to come play quarterback for you guys this year, what do you think about the portal, NIL, where college sports is going, and even we're starting to see private equity get involved in college sports, as I'm sure you're aware. What's your take
So
on all that?
my take is that I am glad that what was happening in a non-transparent way is happening in a transparent way. So in that way, having athletes get compensated for the value that they're driving to their institutions, I think is fair and always has been fair, but was only happening in select cases, generally an NCAA violation at that point. So happy with the notion. How it's happening, I think, is not great in terms of specifically the portal, the rules around the portal, and the fact that there's not a measure of standardization. It's not like, even though if you squint and you look at college football, it kind of looks like a professional league, but there's no salary cap. There are no standard terms applied to each team. So you create this incredibly imbalanced competitive landscape
Yeah.
where and again, it's like there's going to be a shakeout. There has to be. And how that happens, who's the catalyst, unclear. I've heard different solutions, but it will happen in the next, well, I don't think the system's gonna last 5 years. I'll say 3 years on the outside because it's under so much stress. I do think that in the
Is
absence,
the stress, Roger, because the schools are putting out so much money to the players and the coaches are not going to make any money? Is that the main stress?
the stress is that some schools will make a lot of money and most schools will lose money.
Yeah.
That's why. And that the attention economy around college sports is extremely head heavy. There are maybe 5 institutions that are different than all the rest, and they need to be paid for that. But then, as part of solving that, you're gonna hopefully, and I think you will, substantially expand the pie because of how fragmented rights deals are. And as you expand the pie, distribute money to both institutions who don't necessarily have the most power in the attention economy and to non-football sports.
Interesting. Yeah, if you look at the SEC and the Big Ten, you say 5 programs, which obviously Notre Dame's top of that list, but the SEC and the Big Ten are starting to look a lot like the NFL and the NBA. To
Yeah,
me,
no, for sure. I mean, look, there's like you said, whichever institutions you want to pick out, there is a small number of
Yeah.
institutions that are, national, if not global brands. And at the end of the day, are the schools that people want to watch play the most.
yeah,
And so, anyway, I do think that there's going to be a radical restructuring. The tectonic
it seems
plates are
like there
already
has to be.
shifting, and it's not going to be piecemeal. I think that like there may be fits and starts. There'll be schools saying we're doing this or we're doing that. I ultimately think there's going to be and needs to be a larger solution to the problem.
Yeah. Well, I think it's just the wild, wild west. I mean, what we've seen there's no regulation around this. There's no right or wrong answer. Some schools are benefiting and a lot of schools are not.
Well, I think also, I don't know if you agree with this, but everything I hear from my friends within this space is that the NCAA really is a pretty inept organization, and they've had a very difficult time really doing much effectively. And it seems like they should be the governing body saying, "Hey, we need a salary cap. We need this portal situation where somebody's playing 4 years for 4 different teams is just not not good for everybody, things like that. I don't know if you'd agree with that, but
Yeah, I don't know if I think the NCAA in many ways has been so inept and so defanged that ultimately it's going to be the conferences
Yeah.
that create the power ultimately to reshape the landscape. And whether it's through collective bargaining or some other mechanism that Congress says does not violate antitrust, I think that's probably what's gonna happen. I don't see the NCAA as being part of the solution. They're just a toll collector.
It's like any working with any government, working with any school. Like we always talk about, it's bureaucratic BS.
Yeah.
Before we get to the lightning round, I do want to talk about Detroit City. This is something that's close to your heart, Roger. Tom and I are both from Pittsburgh, so similar type city to Detroit, and Tom's made his career.
Better sports town, but
definitely better sports town. Much better hockey town. That's obvious. But the one thing is, Pittsburgh and Detroit, these cities have had great renaissances. And Detroit for a while was 8 Mile in this ghetto city, but it's not the case anymore. And Tom's made his career after Pittsburgh and Tampa. Myself, I've been in Tampa for 15 years. So we're all about the little city, the little town, big city feel. And I know Detroit is similar to that. But what's going on in Detroit right now? What are you guys working on? And what's the future look like for this city?
Sure. Yeah. I mean, we we spent all this time talking about sports. My work in Detroit is almost as big. So I co-founded a real estate business there in the wake of the Opportunity Zone legislation in 2018 called Great Water Opportunity Capital. That's now the largest market rate affordable homeowner in Detroit. We have 2,100 units in the city and 600 in Lansing. We also have started to build energy efficient, affordable single family starter homes in the East Village. So in the city, 3 miles from downtown, these beautiful homes. We're rebuilding a once great neighborhood that was blighted and now kind of all of that removed, grass planted. We're building on this tapestry of 100-acre field 3 miles from downtown Detroit with great support from the community, great support from the city. Super, super exciting. And that's called Great Water Homes. Then on the other side is our food and beverage hospitality CPG business called Brand Detroit, where we partnered with this amazing restaurateur called Ping Ho, who has a restaurant called Marrow, which is one of the best restaurants in Detroit. And together with her, we started a wholesale meat business called Marrow Detroit Provisions that leverages ethical, sustainable supply chain, short supply chains in the Great Lakes states. So great meat products that we're now distributing throughout the state of Michigan and regionally. Me and a partner have bought buildings in Eastern Market, which Eastern Market, if you think of like the meat packing in New York City or kind of the vibe of a Wynwood in Miami, this place that actually Eastern Market in Detroit is the largest market of its type in the country and the oldest. And even in the midst of Detroit's tough 3 generations, if you will, Eastern Market has continued to operate. But many of the buildings, these warehouse buildings, have been fallow. So we've been buying some of these buildings, and actually, we are starting a venture studio, venture fund incubator in this space. And we're actually raising a fund to do that, which is incredibly exciting. We've already started investing in companies and identifying companies for the studio. So we're going to put companies in these spaces and kind of create this innovation district and almost like a network and a program, kind of like a Y Combinator in Silicon Valley,
Love that.
but doing it for food and beverage and CPG in Detroit.
Love that.
Oh, interesting, man. You got a lot going on.
When
do you? You're like Elon. When do you sleep?
Oh, don't say I'm like Elon. I'm No. Sorry. When do I sleep? Occasionally. And, Sax, I don't know if you know this. Andrew moved to Detroit.
You told
Andrew
me
is
that the
now,
last time I saw
yeah,
you. Yeah. He's
Andrew
all
is
in.
now living in Island View and working on our projects with our partner together, and he's awesome. I
Love it.
mean, there's nobody like Andrew to build network, and he has the city of Detroit on speed dial.
It's awesome.
That's cool. That's great.
Tom, lightning round?
Yeah. So this is just going to ask you 5 questions, just quick answers, and the random questions that I just come up with. So they don't make any sense. But so
Secret
what?
codes. Go on. Yeah.
What's your go-to AI bot of choice? Are you a ChatGPT, Perplexity?
ChatGPT.
Do you use ChatGPT more for search now than Google, or do you still use Google more than ChatGPT?
I still use Google more, but then by default, I kind of use Gemini in the context of Google.
Yeah, yeah. I like to ask that because I keep waiting for Google's numbers in search to decline, and they don't seem to be on the revenues on the ad side. But we'll see. They have a lot of other valuable assets. So leads me to the next question. So Elon has announced that he's going to go live with his robo taxi in June in Austin. I don't know if you saw that.
I didn't see that.
Yeah. So and he said, or did he say, or Kathy Wood? Somebody said that they're going to have 100,000 robo taxis up by the end of the year, or maybe the end of 26. I can't remember. Anyway, what's that?
I said I'll take the under.
Yeah, me too. Who do you think wins this robo taxi war between Waymo and Tesla?
Waymo.
Or do you think it's somebody else?
Waymo.
Waymo's got the partnership with Uber. So, okay. When you look at artificial intelligence, obviously the disruptive technology of the decade, whatever, do you see it as creating jobs or taking away way more jobs than it creates? How do you look at that?
I think it'll take away more jobs until we retool our educational system and we start educating people in more purposeful ways that have this vocational bent. Not everybody should be going to a 4-year college and trying to be a banker, lawyer, consultant, whatever, which, by the way, each of which will benefit from AI. But all the manufacturing stuff with the rise of robots, you need a different level of education and a different kind of training that we should be able to provide, but I do not think we're doing a great job of that. So I think it will be a dip and the upswing will be if we get the education thing right.
Yeah. Yeah. Well, every new disruptive technology that's come along, you've been around long enough to see this. Every time we think it's going to destroy all these jobs and it ends up creating jobs we can't even imagine. And my daughter works in digital media. I mean, that job didn't exist 10 years ago.
Yeah.
And so I'll end it with this one because I'm kind of curious. I love that. I follow Tesla stock for grins. So when it comes to Tesla stock, obviously Elon's saying he's winding down Doge. He's going back to Tesla. Blah blah blah. Stock's been hit pretty good. Are you a buy, hold, or sell on Tesla?
I would say I am a hold on Tesla. The reason being, I do think at this point they don't have the best technology. I think that's clear. And I think with his being away, that is hurt, both in terms of product development and reputationally. I'm loath to say sell because the stock has had the shit kicked out of it. And I think a lot of his mistakes are priced in. What I would say is it will be volatile. But it's hard for me to say sell because it's really hard to bet against him.
It's consistent with what we hear typically.
That's what we always say. It's hard to bet against Elon. Hey, Roger, this has been great.
Absolutely awesome.
Yeah, thank you so much. What a great story. You're very inspiring, by the way. And keep up.
You guys are inspiring.
We got to come to Detroit, Tom. That's our next trip.
All right.
Actually, maybe Ann Arbor in the fall. We might take you up on coming to a game with you.
Do it, man. Want to get down on that field? You know who to call.
Never been in the big house.
Good stuff.
Roger, this was awesome. And thank you for everybody for being here today. If you liked what you heard today, throw us a like, throw us a follow on YouTube. Tom and I do this twice a month, and we got some great guests coming up here over the next few weeks. Roger, once again, this was awesome. And so long to everybody. We'll see you soon.
Thanks for spending your time with Skin in the Game VC today. If you want to learn more about investing in early-stage tech like a venture capitalist, be sure to visit the Florida Funders website at floridafunders.com. Join our angel network at no cost and get access to Florida Funders VC-vetted investment opportunities in the next great breakout tech companies.